Welcome back to our channel. In today's video, we are going to talk about starting an SIP at a younger age. So first of all, let's talk about what is SIP. An old saying is that one becomes wealthy, wise and healthy by rising and retiring early. The same is true for one's investing strategy. By getting started earlier in life, one will surely have a higher probability of being financially independent or retiring earlier than others. Investors who participate in systematic investment plans, or also known as SIPs, contribute regular, equal payments to mutual funds, trading accounts, or retirement accounts. SIPs enable investors to routinely save with a lesser sum of money while taking advantage of dollar cost averaging long-term benefits. A DCA technique is used by an investor to purchase an investment utilizing regular, equal transfers of monies in order to gradually create wealth or a portfolio. A systematic investment plan requires making regular, consistent investments in the same type of securities. An SIP typically involves the investor making recurring automatic withdrawals from the funding account over an extended period. Dollar cost averaging is the guiding premise of SIPs. Most brokers and mutual fund companies provide SIPs. In August 2022, the value of Indian mutual fund AUM reached an all-time high of Rs 39.33 lakh crore. A record high for monthly SIP is Rs 12,693.45 crore. The best strategy to increase returns through SIP is to invest in SIP twice when near EMA 200. Now let's talk about how can one benefit from SIP. SIP is a wonderful place to start as it doesn't need a large initial investment. If given adequate time, even a small quantity can accumulate huge value. SIP encourages investors to make a set of investment regardless of the state of the market conditions. Only if the investor is willing to hold the investment for a long period of time, they will be able to experience the magic of compounding through SIP. By beginning an SIP in 2 or more funds, an investor can diversify their portfolio. Reach your financial objectives on schedule. Investments based on objectives are possible. When you notice a decent panic on the street, double your SIP without worrying about timing the market. One of SIP in ETF's main advantages is diversification. Start your investment career as soon as you can. Keep in mind that Rome wasn't built in a day, and be patient to experience the power of compounding. 99% of the money collected by the Lord of Investments, Warren Buffett, came after the age of 50. If one begins investing early and with discipline, one can develop into a committed investor. Now let's have a look at how one can go wrong while doing SIP. SIP is not the best choice for those whose cash flows are irregular because they won't receive a set monthly payment. Unable to invest in a low-cost index ETF and always searching for the next multi-bagger stock or initial public offering or complex high-expense mutual fund schemes, unable to control risky gambling and speculative impulses to become rich quickly, unable to invest in index exchange traded funds and always want to trade the stock market for marginal gains, waiting for market correction to start SIP. Even if one chooses to use SIP, they are unable to automate it and wish to change the schedule of their investments. The rewards might not be at all appealing if the investor is investing for the near term. SIP is undoubtedly not the best option if one has a substantial quantity of money because investing in a few high quality firms with a lump payment or after consulting a financial counselor will provide better profits. In rising markets, SIP returns are lower. When the work starts, you cannot save. Your ultimate wealth will be lesser the later you start investing. We'll run through an example. Let's assume the retirement age of a person is 45 and the SIP amount per month one invests is 20,000. So as you can see in the table, the future value of SIP starting at the age of 21 at 10% rate of interest would be 2,37,93,831, and at 12% rate of interest it will be 3,31,22,518 rupees, whereas at 15% rate of interest it will be 5,56,64,986 rupees. Whereas on the other hand, the future value of SIP starting at the age of 25 at 10% rate of interest would be 1,51,87,376 rupees, and at 12% it will be 1,97,85,107 rupees, whereas at 15% it will be around 2,99,44,789 rupees. So from here you can clearly see the benefits of starting early. The difference between, so you can see the absolute difference between the one starting at the age of 21 and 25 at 10% would be around 86,06,454 rupees, and at 12% it will be around 1,33,37,410 rupees, and at 50% it would be around 2,57,20,197 rupees. So you can see that over the course of 24 years one may save around rupees 2.4 crore by investing a little of 20,000 rupees in a low cost index ETF. This is based on a 10% return scenario. The final sum is bigger the earlier you start. The longer you keep money in the SIP, the higher the SIP amount you set up as you age, and the higher the yearly returns. The longer one waits to find employment, begin saving and begin an SIP, the longer it will take them to be financially independent person. Now let's have a look at how much difference a top-up can make in an SIP. The top-up is a feature that allows investors to choose to raise their SIP investments by a fixed amount at predetermined intervals. It makes a big difference if the person increases the SIP by even just 10% every year. So in conclusion, the emotional maturity, discipline and patience of saving and investing for the long term and sticking to the plan decides whether you will be financially independent and prosperous, not one's intelligence level. We hope that you liked our video. If you are new to this channel, don't forget to hit the subscribe button and also do like and share this video. Thank you so much for watching.